Me again. In this video I would like to continue to explore this big idea of a revenue neutral, dramatic increase in the excise tax on gasoline, and especially the economic implications of such a tax. And so to do that, I put together a chart of data. In the first column, price of gasoline in terms of dollars per gallon. Column 2, quantity demanded in terms of barrels per day. Column 3, quantity supplied, barrels per day. Column 4, is there a surplus or a deficit? And what we see is that at low prices, $2.50 per gallon, consumers want to buy a lot, 79,000 barrels per day, whereas suppliers are only willing to supply 78,000. We have a shortage of about 1,000 barrels per day. But as the price gets bid up to $3 per gallon for gasoline, consumers have cut back their consumption to 78,000 barrels per day. Suppliers have increased their production to 78,000 barrels per day, and we have now neither a surplus nor a shortage. If we were to graph that data, it would look like this, a typical supply and demand curve. Price on the vertical axis in terms of dollars per gallon, and quantity supplied and demanded on the horizontal axis. And we see a downward sloping demand curve. At high prices, people do not want to buy much of this product. As the price falls, they buy more and more. The supply curve, on the other hand, the red line, moving the opposite direction. At low prices, suppliers are unwilling to bring much to the marketplace. As the price is bid up, they bring more to the marketplace. And in fact, we see that equilibrium point right there where the two curves intersect, $3 per gallon and about 78,800 barrels per day being traded. Now let's consider the impact of the tax. I've added some more columns over here. This column relates to the quantity supplied after the tax. Now, the government is saying we want to put this $2 per gallon tax on gasoline, and we are going to leave it up to the supplier to collect that tax and to remit it to us. Well, previously, if the supplier got $2.50 per gallon, they were willing to supply 78,425 barrels per day. Now they're saying we need that same $2.50 plus the $2 tax. We're way down here at $4.50 per gallon if we want to supply the same 78,425 barrels per day. On the other hand, what happens is the equilibrium price, which used to be $3, actually gets bid up to $4.20. And we see at $4.20 per gallon, consumers have cut back their consumption to 78,185 barrels per day. And in fact, going over here, the tax column, we see suppliers are willing to bring that same 78,185 barrels per day to the marketplace. And again, there's neither a surplus nor a shortage. Let's have a look at that graphically. In fact, we have our original downward sloping demand curve, and that has now been unchanged. Consumers don't want to buy gas anymore or any less, except for the fact that they will buy less because of the higher price, but the curve itself has not shifted. The supply curve, the original supply curve, however, has shifted upwards and to the left. Suppliers are saying we are no longer willing to supply as much to the marketplace at those old prices because we have added costs. We have to remit this $2 per gallon tax to the government. And in fact, this is an interesting slide. Let's examine it in more detail. Previously, at $3 per gallon, suppliers were willing to supply 78,000 barrels per day. With the $2 tax, they say, well, now, to get the same quantity from us, we need the $3 we were getting previously plus the $2 tax. So in fact, they would like to get $5 from the marketplace right now. The only problem is at $5, consumers say, we don't want to buy that much gas, that's an outrageous price to pay. So consumers have cut back their consumption. To this point, we actually have a surplus at that high price. And this causes us to slide down both of these curves to that new intersection point, which we saw to be $4.20. And at $4.20, in fact, there is an equilibrium quantity traded of about 78,200 barrels per day. In fact, from the consumer point of view, they've gone from paying $3 per gallon to $4.20. So the consumer share of that $2 tax is a $1.20 increase that they're paying. Surprisingly, it's not the full $2 increase. They're only paying $1.20 of that $2 excise tax, 60% of it. Where does the rest come from? Well, the producers who would like to receive $5 per gallon, in fact, are also only getting that $4.20 per gallon. So in fact, they are taking 80 cents less than they'd like, and I would call that the producer's share of the burden of that tax. They are actually having to absorb 80 cents of that $2 increased tax. 40% of that $2 increased tax is borne by the producers. Who are these producers? Well, Shell Oil, Gulf Oil, Phillips Petroleum, and OPEC nations. Now, this is what's going on in the immediate run. I go to bed one night, I wake up the next morning, the price of gas has gone up. What can I do? Well, to cut back my consumption. Frankly, not very much in the immediate run. Maybe I can call one of my coworkers and say, let's carpool to work. But other than that, I can't do much. On the other hand, as time passes, I'm able to make greater adjustments. And let's examine that. In the short run, which may go from 1 week to 1 year, what happens is our original demand curve becomes shallower. I am able to make some decisions which lessen my consumption of this expensive product. I may, for example, trade in my big gas guzzling vehicle and buy a smaller, more fuel efficient vehicle. This causes, in fact, the price to fall further from $4.20. Now we can see we're below $4, maybe perhaps $3.80. And in fact, what's happening here is the consumers are again bearing a lesser amount of that tax burden and the producers more. As well as that, the amount traded, we've gone from above 78,000, now we're below 78,000. So consumers are definitely using less of this commodity. What about in the long run, which might be defined as a period between 1 year and 5 years? Now we see that short run demand curve becoming even shallower still in the long run demand curve. In the long run, I may, for example, sell my house and move closer to my place of employment. So rather than having to drive 50 miles each day to commute to work, I only have to travel 5 miles per day. And that causes, again, the price to fall further, and in fact, the amount being consumed to also decrease. And this has got to be good for the American balance of trade deficit and also global warming. There's lots of benefits of all of us consuming less oil. And that's one thing I like about this model. So think about that, and I'll be back.